A $3 trillion lifeline wiped out in a matter of days, and when it falls apart, the shock doesn't stay inside Washington. It hits the entire world. What does this collapse mean for the US, for China, and for you? Today, we break down one of the biggest financial shifts of this decade. You're about to see why a massive share of America's government debt is losing the support it once relied on. What's really happening behind the numbers? How could this shake global markets and affect everyday people across the world? You'll discover overlooked details. How foreign ownership of US Treasuries quietly changed in 2025. How one of the biggest buyers on the planet has stepped back from its old role. And what that retreat signals about trust, power, and the future of global finance. We'll explain the economic, political, and strategic forces driving this collapse, and why the US is now turning toward its biggest rival for help. And here's the truth: this isn't just about debt. It's about trust, influence, and shifting financial alliances. Stay with me until the end, because by the last minute, you'll understand why this moment is far bigger than a spreadsheet. It's a warning, a turning point, and possibly a preview of what's coming next. Welcome to the channel. If you want more deep, easy to understand breakdowns of global events, hit subscribe and turn on notifications. Scott Bessent stepped into office in early 2025 as America's 79th Secretary of the Treasury. Before this job, he spent decades in high-level finance, running hedge funds, advising major investors, and traveling worldwide to understand global markets. Now, as Treasury Secretary, Bessent oversees the entire financial engine of the U.S. government. His mission: steer the economy, manage federal debt, and protect the financial system from global shocks. When we talk about a Treasury Lifeline, we're talking about something huge: the enormous network of debt and bond market liquidity that keeps the U.S. economy running. Here's how it works. The U.S. issues Treasury bonds to raise money. Foreign governments, central banks, and global investors often buy them. Those purchases give the U.S. government the cash it needs to operate, pay debts, and fund public programs. In return, foreign buyers get what has always been considered one of the safest investments on earth. This foreign demand keeps interest rates lower and keeps confidence in the U.S. economy high. And for years, China has been one of the biggest buyers of U.S. debt, once holding more than $1 trillion worth. China was one of the main anchors of the entire U.S. debt market. But that anchor is now shifting. Over time, China has reduced its holdings. By early 2025, its share dropped to around $740 billion, the lowest level since 2009. Meanwhile, other foreign buyers have stepped in to replace part of China's role. But not all of it. This matters. When a major buyer steps back, America has to find new investors to keep the system stable. Less demand means the U.S. faces higher interest rates and tougher debt management challenges. That's where Scott Bessent comes in. His role isn't just about crunching numbers. He must navigate shifting alliances, worldwide investor behavior, and rising uncertainty. Treasuries have always been viewed as rock solid, but when trust changes, the impact spreads far beyond Washington. Recent data now shows a severe decline in China's Treasury holdings, dropping to around $730 billion by mid-2025. This happened even as other foreign investors were still buying. So while the world is investing, China is stepping back. And that shift sends a powerful message. When big buyers pull away, U.S. debt becomes more expensive to issue. Higher yields mean higher borrowing costs. And because Treasury yields set the benchmark for the entire American economy, interest rates rise everywhere. Home loans become more expensive.